Hello and welcome to the next trades and tutorials video. This is Geoff Bysshe, president of MarketGauge.com, and in this video I am going to show you what I think is the scariest part of the way this market is set up. And I'm going to show you it in the context of two different really powerful metrics. One, phases, and two, Fibonacci retracements. So before I get to it, let me just make sure that if you're just finding us on YouTube, that you subscribe to our channel. And if you don't already know the place you can find more videos and more posts and helpful videos like this, you can do it at marketgauge.com/tutorials. And finally, I want to make sure you know you can get this video in HD. And you can do that with just clicking the settings in the lower right hand corner, selecting HD. It'll make it a lot clearer. I think you'll like it. Now, before I get started, I'm going to show you Fibonacci in a really simplistic way, and I'm also going to just begin to touch on the concept of market phases. And Mish, our head swing trader, will be doing a webinar this week on phases. And so if you're seeing this as I've had it released and you haven't heard about the webinar, you can go to marketgauge.com/phases-webinar, totally free, and she'll get into much more detail on the power of market phases for predicting and anticipating major market moves. All right, so the two things I want to focus your attention on are, first, where the Qs are relative to their 200-day moving average, and I'll blow that up in a second, and also where many of these markets are relative to a really critical Fibonacci retracement level. Now, I'm not a huge user of Fibonacci. I use Fibonacci in a very basic way, but it's still very powerful. So if you're really into Fibonacci, you're probably going to view this as overly simplistic. However, I think you'll also appreciate that it works. It works really well, and it works really well even if it is used in such a simplistic way. So let's get back to why I'm describing this as the scariest part of this market, and the reason I haven't made these charts any bigger yet. So in the upper right hand corner, we're looking at the Qs. In the upper left hand corner, we're looking at the SPYs. In the lower right hand corner, we're looking at the IWMs. The gray lines on these charts are the 200-day moving average, and the magenta line is the 50-day moving average. So if I look at the Qs on just a relationship to where it is to the 200-day moving average, the Qs are the strongest. Now, as it turns out, in terms of the year-to-date performance, the Qs are still the strongest in that respect as well. So one of the greatest patterns for shorting markets that are rolling over for a big correction is when markets severely break the 200 and then rally back up to the 200, consolidate, and then roll over. Right? That's what the Qs are in the process potentially of doing. Now, the reason this is particularly scary, as I've been describing it, is a couple of reasons. First of all, as I just said, the Qs are the strongest of the equity markets right now in terms of the U.S. equity market. So the SPYs aren't even close to their 200. The IWM is not even close to the 200. And the 200 for the first time in a long time in all these markets is either flat or down. Right, so how do we look at this and how do we use this? So the first thing to note, as I just said, the strongest index, if the market is going to recover and continue higher, the strongest index should be the one to tell us that, to give us that heads up. So let's focus on the Qs, knowing that the others are just weaker. And that would imply that if you want to figure out whether or not the market's going to continue higher, keep an eye on the Qs. If the strongest one starts to roll over, then it's unlikely that the weaker ones are going to hold you up. So a really easy way to look at this pattern, the pattern being breaks the 200 and then rallies back up, and the question then is it going to recover above the 200, or is a 200, a huge institutionally watched resistance level, going to put a lid on it? Right, so you want to look to see where the market has consolidated around the 200 if it gives you that opportunity, as it has. So those levels are very easily defined right now. The initial level, you could see, was defined by this white line. Then we had the Fed announcement, which gave us a spike above the 200-day, held in by the 50, but I'm really going to focus on the 200, the big level. So now that gives us an upper area to really use as a significant break above the 200 to look for a move up. The significant level on the downside could either be down here near 100, or we've got some consolidation levels right here, probably closer to the 104 level. All right, so if I look at the Qs, I see this zone right in here, which pretty clearly defines a well-defined price range by which I can determine markets might be likely to move higher if they break above and lower if they break below. It's really that straightforward, but what makes this so scary or powerful is the fact that this is the leading index potentially rolling over, and the other indexes are not even back up to their 50-day moving average, which is under the 200-day. Like I said, they're weaker. All right, so let's take a look at one other just simplistic way of looking at a market that's gotten hit hard and how well has it recovered. And so an easy way to do that and a powerful way to do that, and this is also levels watched again by big traders, is to look at the Fibonacci retracement. And I'm going to call it a Fibonacci retracement because Fibonacci is the name or the indicator. Fibonacci is the mathematician that's figured out a lot more than what I'm about to tell you. But the big number is 50%. And in this case, what I'm looking for and what I would advocate looking for is when you get a significant move in the market, look to see whether or not the market can recover 50% of that move. If it stays below the 50% level and starts to roll over, then the market is still weak. Now, in this case, I'm very specific about using the closing value, not the extremes. And the reason I'm doing that in this case is because the extremes here, there wasn't a whole lot of trading. But if you look at these levels, if you look at the correction in terms of a closing basis, so this was the closing high, this is the lowest closing low, and then the question you want to ask yourself is, does the market get back up and really, again, close and trade over the 50% level? And now in this case, and in so many of the indexes and sectors, if you look at where the market is trading relative to that 50% level, it's been consolidating or hitting its head on that 50% level. So not only are these markets, especially the Qs, rallying right back up into this 200-day moving average, which from a phases point of view, again, which you can learn a lot more about if you attend Mish's webinar, but they're also coming right back to this 50% level. Now, the reason the 50% level for me is so significant is because it implies, right, that we have had a significant correction or retracement after the big move. In this case, it's a big move down. So that leaves plenty of room for the market to move right back down without even taking out a significant low. All right, so if I put all this together, we have the Qs really should be focused on as the canary in the coal mine, so to speak, for this current market condition in terms of which way the market's likely to continue to go higher. And also keep an eye on this 50% retracement level. It's really easy to do in most platforms. You saw me pull it up in my TradeStation platform. In TradeStation, they call it the Fibonacci retracement lines, but really all I'm doing is taking the high, and in this case the low, on a closing basis and looking to see where the midpoint is. Like I said, if the market closes and trades above the midpoint and starts to move higher, it is somewhat of a bullish sign, indication that it has recovered. But if it can't get back over that 50% level, the market's still very weak. And if you combine it with other things like phases, it's incredibly powerful. Unfortunately for the bulls, the news is there isn't a whole lot out there that has recovered the 50, held over its 200. When I say recovered the 50, recovered 50% of its correction and holding over its 200 and putting us in a position where we would have some kind of strength to rally. In fact, if we take a look, this is another metric that you can see on our site very easily. If you've seen other videos, this probably looks familiar. In the little big view area that I talked about before, you can find this, marketgauge.com/tutorials. Then go to sector summary, and this will give you the major sectors of the market. And we look at them in terms of 3 different time frames, but from a 6-month time frame, which is a really important time frame from a momentum perspective, we've only got 2 that are positive right now. And again, if you've seen this chart below, you got a 40-week moving average here, which is the same thing as the 200-day. In this case, we're looking at the SPYs. The magenta line is the 10-week, so that's the same as the 50-day. And you can see the number of sectors from that top table. The green is the total number of positive sectors. The red is the total number of negative sectors. And then the sectors are not only negative right now, but the trend has been predominantly down. And until this really shapes up, it's going to be hard for the market to rally in general. So we need to see the number of sectors shape up. We need to see the Qs get back over the 200. And again, if you're looking at other markets, if you're looking at different sectors, take a look at that 50% correction line as another benchmark. So scary because, just to sum up, scary because if we put a range around the current price action of the Qs, it's right back up to the 200. Can't get over the 50% retracement level, and if it starts to head lower, there's plenty of room on the downside. For the optimists out there, you know where you can get bullish on the upside if it takes out the high of this trading range. So that's it for now. I hope that's helpful. Like I said, even if the market gaps down or trades lower today, these are levels you're going to want to watch. Even if it moves down, comes back up, bumps its head, comes back up into here, you know you're kind of neutral. And now you know where you can look to turn bullish without feeling like you have to wait all the way to the highs. And if you're seeing this video in time to attend Mish's webinar, go to marketgauge.com/phases-webinar, and I think you'll enjoy it. Good luck with your trading.